Hello and welcome to Sovereign Financials, financial education for everyone. Hi guys, welcome back to Sovereign Financials. Today we're going to talk about housing market update, which includes basically home prices dropping, increase in interest rates that was just done by the Fed today, and an increase in foreclosure rates. So if you haven't watched my video that I posted last week on the Housing Bubble 2.0, I highly recommend you watch that first and then watch this video afterwards, as this is just going to provide some updates in regards to the housing bubble. So here on Redfin, we have an article that says more than 1 in 4 home sellers dropped their price last month. And if you take a look here, it says that but as a result, sellers are feeling compelled to adjust their expectations and their prices. In the 4 weeks ending on September 16th, 26.6% of homes listed for sale had a price drop. This is the highest level on record since Redfin began tracking this metric in 2010. So 26% of homes had a price drop in September, which is a pretty large amount of homes. And then if we go further down in the article, it kind of goes into the details specifically about these metrics and shows the share of homes with price drops have been posting year-over-year gains consistently since late March. And then it goes over some of the specifics. In Las Vegas, there's a 28% drop. San Jose saw a 25% drop. Seattle saw a really large drop, 37%. And these are homes that are having price drops. So out of all the homes out there, 37% of the homes for sale in Seattle had price drop. Not the prices of the actual house dropped by 37%. We're not at that stage quite yet. In Atlanta, there's a 27.9%. Those markets had the biggest year-over-year increases, price drops. And then there's a bunch of other places too that are dropping their prices, and we'll get to that a little bit later. Now, in the past, I looked at California home prices. Today, we're going to go over Washington, a little bit about Florida and New York. So this article here was written by the Daily Chronicle, and it says August housing market shows large home supply. And as what happens in the market is as you're going into a bubble, the price of the homes go up, there's this huge frenzy, and then the supply of houses for sale goes down as people are trying to buy all the houses up. Then as the bubbles come into the top and you start going down the other side of the bubble as it pops, first the supply starts going up in that people aren't buying as many homes, and then people are still listing their homes for sale, so the supply goes up, which is what this article is going to talk about. And then as people realize that they are not able to sell their homes, then they start dropping prices, which we're still seeing at the same time. So there has been incremental increases in listing inventory in the past few months. This is specifically in Western Washington. And then he doesn't give the exact numbers, like what percentage of, but basically the home supply is going up. And this specific author recommended that sellers should be careful to avoid overpricing, as savvy buyers are wary of properties pushing on the upper end of the market. So basically he's saying that buyers are realizing that these home prices are getting a little ridiculous. They're not buying them as much, and then thus Washington is having an increase in the home supply there. However, prices were still up when this article was published, but that is changing. So I was going to post this article yesterday, this video yesterday, but we were pretty sure there would be a September rate hike by the Fed, about essentially almost 100% possibility, and then a 90% possibility of another rate hike in December. However, I waited till today to post this because I wanted to see what the actual Fed was going to do, so this video could be as up to date as possible for you guys. So this was published in Market Watch. Fed hikes interest rates, signaling strong support for another increase in December. And then also important to note here is the FOMC drops language saying its policy remains accommodative. So what that means is before the Fed has stated that if we're going to increase the interest rates, but we're going to remain accommodative, meaning that if the housing market and the stock market start dropping too much, that the Fed would stop the rate hikes. But they got rid of that statement now, which means that they might be more willing to increase rate hikes even in a downtrending market. I don't think this article specifically stated it, but the interest rate increase is going to be 0.25% specifically. So it's going to increase the ratio. So they call it 25 basis points. So it's just a fancy way of saying that they're increasing the interest rate by 0.25%. So the Federal Reserve raised interest rates for the third time this year and signaled it would raise the cost of borrowing again in December, which we kind of already assumed that they would do that. And then rates are now at their highest level since shortly after the bankruptcy of the Lehman Brothers in the fall of 2008. More importantly, I think, is the decision was unanimous, so that 90% chance of a rate hike in December probably went up closer to basically 100% unless something crazy happens. And then this part is interesting too, right? Like I mentioned before, that they got rid of this remains accommodative part. It says at the same time, senior Fed officials dropped long-standing language saying its stance on interest rates remains accommodative. The unexpected removal of this language would appear to give the Fed more flexibility on how rapidly it raises interest rates in the next year. And people will call this dovish. So some investors saw it again as a sign that central bank may turn dovish soon. And what that just means is basically non-aggressive. Like they're going to leave if the housing market starts dropping. They're not going to do anything to intervene. Now, interest rates and mortgages, right? So if interest rates are low, then people can have a high house price, and the mortgage payments won't be that bad. I mean, the mortgage payment in the beginning, the bulk of it goes towards interest. So if you have a 3% interest rate, sure, some people can afford to buy a $600,000 house. But if that same person that can afford $600,000 when interest rate is 3%, maybe they can only afford $450,000 if the interest rates hit 5%. So, as the Fed increases their interest rates, you'll see that the 10-year Treasury yield starts going up, and we've seen that. This is over the past 1 year, and you can see here that the trend for the 10-year Treasury note has been increasing, and this will continue to increase as the Fed raises interest rates. Now, if a bank can get a guaranteed 3% by basically investing with the U.S. government, basically that sets the lowest amount that they'll ever give an interest rate for you to buy a house, right? Because if you have a 100% guaranteed chance of getting 3% from the U.S. government, if you're going to give someone a loan for a house, it's going to be higher than the guaranteed rate because individuals can always default on their homes. So basically, you should not be able to get home loans for less than 3%. And we have more data on that too here. So this is off of Bankrate, as you can see up here. But this is the 30-year mortgage rates, and if you look at the 30-year fixed rate, which is the most common, as you can see here, the trend has been going up, right? And right now, as of September 19th, the 30-year fixed rate is 4.88%. Might be a little bit hard to see. Hopefully you guys can see that on the video. But that's kind of been increasing steadily. It was 4.6% in the past, and this is without specifically a rate hike here. However, with the Fed raising the interest rates another 0.25%, also known as 25 basis points, that should take the 30-year fixed mortgage closer to 5%. And at 5%, people are not able to afford as expensive of houses, and if you can't afford to buy the house, then sellers have to reduce their pricing, etc. And this will cause the bubble to continue to go down. Now, with the interest rate hike in December, that should take interest rates to 5.25%. Which will then further decrease the amount of money that people can get for their homes, causing the bubble to pop. And the Fed specifically got rid of the statement saying that they will remain accommodative, meaning that if home prices do go down, the Fed isn't going to do anything about it. This is just another view of the same thing here. So 30-year fixed mortgage rate average in the United States, and you can see that the mortgage rates have been uptrending and going to continue to uptrend, with the planned rate hike in December, which is essentially almost guaranteed, and then with another planned 3 rate hikes next year as well. All right, so looking at Florida here, this is looking at foreclosures. So the rate of foreclosure starts in South Florida has spiked. And if you look down here, it says the report, which tracked foreclosure filings issued by county governments on single-family homes and condos, shows 1 in every 1,100 housing units in Florida, which is a 35% increase year over year, was subjected to a lis pendens, which is a filing by a bank warning of a pending foreclosure activity. So what they're trying to say is that in Florida, there's a 35% increase in foreclosures starting in August. They say here that this increase is not start of a reprise of the 2008 financial crisis, but if you look at all the other data, this is actually kind of pointing towards like a repeat of 2006 to 2008 bubble. This is, pull this up here, this is a foreclosure statement by Atom Data Solutions. So if you haven't looked at their stuff here, I'd highly recommend going to their website. They got a lot of useful information, like a lot of figures and stuff you can look at. I've seen other people on YouTube saying that foreclosures increased by 44%. But that's not what this data is saying. It says foreclosure starts increase in 44% of U.S. markets. That doesn't mean that there's a 44% increase in foreclosures. It just means that in all the markets, basically all the different counties in the U.S., 44% of the counties have an increase in foreclosure rates, which is a very different statement. Still, I mean, there's still an increase in foreclosures, just not as much as other people are claiming. So it's kind of what they call, it's kind of summer foreclosure heat wave. It's kind of a cool little map here. But all the red areas are areas of high foreclosure rates. Yellow is like medium, and then like the small little areas of like green basically means there's no increase in foreclosure rates there. So the biggest foreclosure areas you can see here is Los Angeles, San Diego, Indianapolis, Austin, Texas, Houston, Texas, Florida, essentially the whole thing, and then a good portion of the East Coast all have an increase in foreclosure rates, and the red meaning they're all large increase in foreclosure rates. So let's go down to the article here. And if you look at this, so a total of 30,000 U.S. properties started the foreclosure process for the first time in July, which is a 1% increase month over month and less than 1% increase from a year ago. But this is what's interesting about it is it's the first year-over-year increase in foreclosure starts nationwide following 3 years of months of year-over-year decreases. So for the past 3 years, foreclosure rates have been decreasing, and this is finally the first uptick in foreclosure rates. Now, if you look at on a statewide basis, Florida had a 35% increase in foreclosure rates, which is in line with the other article I showed you guys. California as a whole, foreclosure rates are up 3%, but we'll get into some more details about that in a second. Texas is up 7%, Illinois by 7%, and Ohio by 2%. But if you take a look at our graph up here again, right, like there's not a lot of people that live way up here in Northern California, but the bulk of the population, I think, is more down here along the coast. You can see the along the west coast here is red, very small sliver, and then Los Angeles, San Diego, a lot of Southern California, and then in Texas, same thing, right? You have very high population density areas like Austin and Houston, but I don't know if there's any small cities up here. I'm sure there is, but there's not going to be a lot of foreclosures there because there's not going to be a big population to look at in the first place. So if you look at by metro areas, right, looking at specific areas and their foreclosure rates, Los Angeles had an increase in 20% of foreclosures. That's pretty large. Houston, Texas had a 76% increase in foreclosures, which is just gigantic. Pennsylvania, 10%. Miami, Florida is up by 29%, and San Francisco is up by 10%. So the high population areas are having much bigger areas of foreclosures. And I've told you before in the past, right, is with inflation rates being low and people basically maxing out the amount of debt they can hold, that if people have any kind of hardships, whether it be like a small job loss or a decrease in their pay or a natural disaster that could put people in a bad situation and have them to foreclose on their homes. And then they're saying the same thing here. Most susceptible to rising foreclosure starts are affordability challenged markets where home buyers are more financially stretched, which means that the amount of loans to income, debt to income basically is very high, and markets with some type of trigger event such as a natural disaster or large scale layoffs. I forgot to mention the first part here where it said gradually loosening lending standards over the past few years have introduced risk back into the housing market, and that additional risk is resulting in rising foreclosure starts in a diverse set of markets across the country. Basically is if you can barely afford your home in the first place and then something very small happens, that you lose your job, there's a decrease in pay, all of a sudden you can't afford your home, and then you go into foreclosure. And then this article here was looking at New York. Actually, let me scroll to the top of this here for you. So it says New York City home sellers are cutting prices like it's 2009 and then some. It's a pretty extravagant title, but the numbers do look the same. So New York City's home sellers, tired of waiting for buyers, slashed prices on almost 800 listings in a single week this month, the most in at least 12 years. So 12 years puts us all the way back in 2006, which is exactly at the top of the bubble. In the week of September 9, there were 774 homes in Manhattan, Brooklyn, and Queens that got a price cut. And this is the most for any 7-day period in data going all the way back to 2006, which is just like what we're talking about. And if you can see here, this isn't too bad of an increase from 2014, 2015. Bigger increases to 2015 or 2017, and then all of a sudden we have like a nice little spike there. the amount of price drops have gone pretty significantly upwards. All right, guys. So that's my update for this week. It's a little more informal this time. Just kind of want to give you guys a heads up on some of the newer data that's coming up. I'm just going to kind of keep you updated. If you like the video, I'd appreciate it if you guys can come down to the corner down here, the like button, subscribe, and share it with your friends. Let me know what you guys think. All right. Thanks, and I'll see you next week.